In this lesson, we are focusing on the basics of timeframes and the way in which we can use them to help us make better trading decisions. Now, we will be developing our knowledge of timeframes right from this entry-level course right the way through to our most advanced courses. Now, the basic principle of timeframes is simple, in that each timeframe provides us with a series of candlesticks which each represent the price movement during that timeframe period. The key timeframes we will be using is the 1 minute, the 5 minute, the 15 minute, the 1 hour, the 4 hour, the 12 hour, the daily, the weekly, the monthly. And there is a specific reason why we use these timeframes, which we will shed some light on in future lessons. So let's begin then by marking a few monthly levels of support and resistance. Now, it is crucial we begin our level marking on the highest timeframe and work down. And this is to ensure levels are given the correct strength. So we can actually look at an example of this and why it is important. So on the monthly time frame, we have the swing low, which we're going to classify as this gold colour, like our monthly key up here. And then we have the swing high of the swing low. And we see how well this monthly level is respected. Initially, it's resistance, as we would expect. Once we break out of that resistance, look what we come back to use as support in the future. Our level of support. So what was once resistance turns into support, as we have stated in the previous lessons. If you are unfamiliar with support and resistance, look at level 2 of a step in the right direction to familiarise yourself with levels of support and resistance. So, as we have said, it's crucial to mark your levels on the highest time frame and work down. And the reason for this is, if we go into a lower time frame, so let's say the daily time frame, and we go all the way back here, and we begin marking our levels on, in fact, let's go to the 4 hour even. Let's say we jump straight into the 4 hour time frame and begin marking levels. We've actually not looked at the higher time frames. We move into here and we say, oh look, we actually have a 4 hour, so this teal colour, based upon our key up top here, the 4 hour. We have a 4 hour swing high and we have the low of the swing high. And we can cut the replay tool here. So actually, you can see we hit our level and we have first hit rejection up here, exactly as we had expected at a level. But now, if we are in the 4 hour time frame, our expectation of the reaction based upon this level is going to be different than what it would be if we had actually correctly identified this as a monthly level. We would expect to see a larger reaction because of the level strength at a higher time frame level. And this obviously significantly affects our decision making and our expectation off of this level. So where we might say, well, we have a 4 hour level here, so we may expect a small reaction. Now again, there is no static rule in that a 4 hour level you may expect to see a 4% reaction off of, where a weekly might be 10%. There's no static rule, but each level does have a relative strength attached to it, as we've explained. So we would indeed expect a monthly level to have a much bigger reaction off of it than a 4 hour and a 1 hour level. Let's just say then we identify this swing low here that we are going to buy as a nice example on the 4 hour, or even this swing high of the low, which is now support. So let's say we're now going to place a buy here. We're expecting a reaction off this level, but we're trying to get into the move to continue our uptrend, which again we would be stating is a 4 hour. So to continue this uptrend, which also a raise from this point to this point, which we will touch upon in the future. So we're saying that we're going to break this mini trend, come down here, use this level of support. We're going to buy in here. So we play this out and look at this. We have a big dump down and it actually ignores these levels. And you may ask, well, why is that? Well, we know why that is. And it's because actually this is not a 4 hour level. This should be a monthly level. So if we remove these, go back out into the monthly, we actually know that this level here has hit a monthly level. It has hit the swing high of the swing low establishing candle. So it's hit a large level of resistance. Hence we have seen this fairly large, and obviously it may not have finished here. Let's move it to the bottom point before it begins to move up. So it's still moving down. Let's go right to the point where it begins to move up. So let's say this is the bottom then. So actually this hit of this level, this monthly level, has ended up creating, this lowest point, a 30% move. So that is why we begin marking on the highest time frame and work down. So let's now go and mark a few monthly time frame levels to see how well these levels are respected. So we've marked these here. We also have the swing high as resistance and the swing low of the swing high here. We also have the new swing low and the new swing high of the swing low. And actually look at how well this level in here, or these levels in here, end up creating this really nice accumulation zone here. So you cut movement down, distribution, accumulation, move up. Exactly as we discussed in accumulation distribution phases. And you see just how well this level is resistance here until it breaks out. Again, we can mark a few more levels, but we don't want to get rid of that level. We want to get rid of this accumulation box. We also have, now we don't have a monthly high here because this is a distribution candle. We have a monthly high here. Let's turn the magnet tool back on. And then we have the low of the high here. And we see how well this level is respected. Price moves over it, it comes back down, it bounces off it, uses it as support. The exact same here, price breaks resistance, comes down, bounces off it, uses it as support. So there you see it, a few levels which are respected to the T. You see how this respects the monthly level over here. So very crucial to be aware of this. Again, if we just mark this swing low, the swing high, which is up here, look at this, comes down, resistance, 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 breaks over it, tries to support the move before falling back down. So we've applied a few monthly levels to our chart. Now what would we do? We would move into the weekly time frame. So if we move into the weekly time frame and move into this first swing low on the weekly, which we believe is blue, based upon our key, we have the swing low and the swing high of the swing low, which you can see is resistance right the way until it breaks out, which obviously fuels the move. We also have the swing low and the swing high of the swing low here. You see, comes down, bounces back up, loses it, resistance in the future. This is resistance in the future until it breaks out. We also have a nice swing low here, look. And then the swing high. Again, price comes up, hits the level of resistance, pulls back, breaks it, comes back down in the future, used as support. Support lost, resistance, resistance. So again, now you're seeing just how well these higher time frame levels are respected. Now, another key point is when we begin marking our levels, especially our monthly and our weekly time frames, we must begin marking them on the left-hand side of our screen. So we go right the way back to the beginning of our price action and we begin marking our levels here. And this is so that if we just clean up a few, in fact, we can show this like it is now. If we, for example, was to come into the screen here and say, oh, look, we have a new monthly low, when actually this is a test of this level back here. So rather than coming in here and marking us, beginning our TA from the right-hand side, we must go back in time. And that way, we do not end up overlaying our levels. So it's important we start from the left-hand side and we start from the highest time frame and work down. Now, when it comes to the daily time frame, there's going to be a difference. And the daily time frame and below, when we begin marking our levels on the daily time frame, rather than going all the way back here and marking all these levels, we are going to go into the more local vicinity to mark our daily levels, because you are going to have a lot of swings on the daily time frame. So rather than, you know, spending a lot of time marking out all these daily time frames, we suggest that it's important to go into the more local region and mark those levels in here, because levels on the daily time frame that you begin marking in here, which obviously would be red, are not going to be hit within, you know, the next few days. And if we are doing day trading, we are going to be focused on the more current price action. So rather than going doing all these work, marking all these daily that would be in here, you know, they'd be all over the place. Be one here and, you know, one up here, and obviously you'd be looking at the accuracy. So rather than doing that, you would come into, so we can delete those, you would come into the more local vicinity. You could come into here and say, oh, look, we have the daily swing low here, the swing high of the swing low, swing high, swing low, and you may do the exact same for, and this is the same with trend, you would have the high here, the low of the high here, and again, you would go through through this, you can see how well that swing low is used to support here, to support this move. Then this swing high of the swing low is resistance. So you see that? You have first hit, rejection, first test. So this level in the future, this one we have here, can now be broken. So you could maybe change that to a dashed line. So again, remember how I went into here and I marked this level? Actually, you need to be stepping back and again using the left-hand side. So you work from the left-hand side, work forward. And also, just to reiterate, start on the monthly and work down. And the daily time frame has a different, you're going to go into the more local vicinity. Just like on the lower time frames, you're going to focus on this lower vicinity. There's no point going into the 15-minute and marking a 15-minute level in here right now. Okay? So you apply those levels on the more local vicinity. Let's take a look at another example now. And actually, let's look at a stock. Let's use Tesla. Everyone loves Tesla. So we can start on the monthly time frame. Let's just go straight in. We have a swing high here. So we'll mark it this gold colour. With the swing high here. And the swing low of this high. And we're just more focusing on this. So initially, actually, the correct thing to do would be to mark this level first. Working from the left-hand side of the screen. And then we also have the low. And the high of the low. Now, you wouldn't be marking the low here on this monthly time frame because its swing has not finished at this point here because you've seen a new distribution candle after it. So you couldn't say this was the monthly low's final point. Technically, although this is a lower price than this candle here, you would go to the low before the next accumulation candle because this accumulation candle obviously stopped this distribution. So we have these levels here, and then we would move up to our swing high, then our swing low of the high, and we look how well we see that level respected. Lose it as support, come back up, hit it, resistance. First hit, rejection, look. Let's move in. First hit, rejection. First test, break it in the future. Come back over it. Come back over the level. Come back down, bounce back off of it. Then obviously it turns into support once more. Look at this level here. Monthly high, comes up, over, hits it, bounces off. If you're going to the weekly time frame, look at how well that level is respected there. So that's exactly what we would do. And actually, let's actually plot our monthly trend. So we have a trend from this low point here to this low point. We would have that gold as well. So look at how well this trend is respected because it's a monthly time frame, a strong level. It is created from that point back there to here. Is respected here, 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 and then it moves off of it. Okay, so we have a nice strong trend there. We would now go into the weekly time frame. Let's do the exact same on the weekly time frame. We would have, so we will begin in, we can begin in this region here. Actually, we can begin slightly higher up. We can go with our weekly swing high, which we said was blue. So that's weekly swing high. Now, the low of the swing high is not a weekly because we have already identified it's a monthly. So again, this is why we start on the high time frame and work down. So we have a small movement down here. We end up creating the swing low here. Now, again, this is not a swing high of that swing low because we know it's a different level. But look at how well this level is resistance in the future. First hit, first test, break it, move up. We end up creating a new swing low down here. And again, we don't have a swing high of the swing low here. We just have the swing low. And then we end up creating swing low of this candle swing high here. Look at how well it's respected. Resistance. Broken over. Used as support. Moves up. So you are beginning to now see just how well these levels are respected to the T. Because they are high time frame levels. Just like here, currently Tesla being supported by this swing high on the weekly of the weekly swing low distribution candle, which is here. You see, supporting the move. And on the daily time frame, you would come into here now and then begin marking your dailies. So you could say this was the daily swing high. Now the technical swing high of this candle, do we actually look at is, sorry, no, it's a weekly. So this would actually be a weekly. And then you would have a weekly swing low of the high here. resistance, resistance. Go into the daily candle, and then obviously you would begin marking out your daily levels as well. So it's crucial that we begin to understand that we move from the highest time frame and work down. On the higher time frames, we start from the very left-hand side of the screen, or from the beginning of price action, and move to the right. And then from the daily time frame, we begin in the more local vicinity. Now, technically, you can mark all the daily time frame, guys, from back here. But like on Tesla, there's no point marking daily levels from back here when you are all the way up in here, because you're not going to be reaching this anytime soon. So go into here, mark your lower levels on the more local piece. So that is it. The basics of timeframes and the way in which we can use them to make better trading decisions.